One mistake you should never catch yourself doing when trading options is holding them to expiry. There are multiple reasons for this. Let's imagine a simple scenario in which you buy a 3-month call with strike price 200 as the stock is trading at 100. You pay $1 for the call. If the stock actually goes to 200 in the first couple of weeks, you have probably already made a killing, multiplying the initial cost tenfold. But what happens now? Do you want to keep the option and wait it out, or do you want to close for profit? Take your time and think about it, and you can answer in the comments. Let's go through the problems of waiting it out. And the first one is time decay or theta. Theta is what you pay for owning gamma. Let's simplify this. Options are a great way of gaining convexity, like the example earlier, where the stock doubled in price but your call increased 10 times. This was due to convexity and it isn't free. Gamma is simply the reason why your option price doesn't increase linearly with changes in the underlying. It follows a more upward sloping curved path. And having this ability is costing you theta, which also doesn't follow a linear path. This means that as you approach expiry, you are paying more and more as time passes. Or easier said, your call is losing more of its value as it approaches its end of life. Since the last hours of an option's life are worth more, and an option can lose value rapidly during these hours, even if the underlying price moves in the right direction, you do not want to get to that point. It introduces too much uncertainty and outcome binarity. It is true that the larger theta cost you start incurring is a byproduct of the large gamma you own near the end. So it is not like you are paying larger cost without a reason. You are compensated in terms of gamma exposure, but for most starting traders and directional bets, you probably won't know how to handle this gamma and are better off rolling before that window of decay starts. When dealing with options or trading in general, you want as little uncertainty as possible. This is done by isolating your thesis as much as possible, betting on only what you want to bet on, and removing the risks of everything else. You might create a fundamental view on direction in something, but it is difficult to have it on, let's say, magnitude and timing at the same time as well. For a long option to be profitable at expiry, the underlying not only has to move in the correct direction, which you might have nailed, but it also has to be by more than the premium paid and also before the option expires. Many trades become profitable temporarily before expiry but end up worthless because the move stalls or reverses right before expiration. Closing the trade early allows you to monetize favorable moves without needing perfection. Another risk is volatility. Option prices reflect the expectations of the market about a stock's movement through implied volatility. Often after a large and unusual move in any direction, implied volatility spikes, but this is only temporary more often than not. As the stock goes through price discovery and finds its new fair value, it is considered that it will stay there until new information hits the market. That is why implied volatility is mean reverting and doesn't remain high for the most part. Holding an option whose IV has spiked on an event opens you up to the risk of the famous IV crush. The option's high vega can hurt your position drastically as volatility comes back down, even with the underlying moving as expected. Now back to gamma. The same thing that makes the option so great and exciting is what creates large problems when holding the option until the end. Near expiration gamma for OTM options is high, meaning small adverse price moves cause large delta changes. The option becomes more and more binary, meaning it is worth something or either zero. This is something that is hard to project and makes your strategy more like gambling on a last-minute move than trading. This position is useful in other strategies like gamma scalping, but for most of starting traders it is more of a trap than a perk. When having a combination like a call spread go in your favor, it is painful to see part of the profit left hanging due to time left to be collected in the short leg, but waiting it out often proves to be even more painful. You can most likely capture 50 to 80% of the maximum theoretical profit well before expiration. Waiting it out to try and get the whole cake for yourself requires taking disproportionate risk. If you look at an option payoff at expiry, you will see that it is linear and is only dependent on the underlying price. It doesn't have any time, volatility, or anything else to influence it anymore. This is significantly different from the payoff profile at the start. As you approach expiry, the payoff of your strategy changes as well. The trade is not the same as the one you put on at the beginning. The conditions have changed, and you might now be risking more and more to collect that last piece. At every point in time, you should be asking yourself, from this new perspective, if you still want to be in that trade and if you would have entered it now if you weren't already in it. If the answer is no, you should probably close the trade. Like mentioned multiple times already, there are some strategies like those theta-based where you want to hold the sold option until expiry since the decay kicks in heavily near the end. But for the majority of option buyers, this is not the case. You want to be agile, just like it is the case overall in trading, jumping in and out before there is significant dependency on where the underlying lands exactly at expiry.